manufacturers, retail businesses, restaurants, everything that you can think of. So in order for an application to be considered on time, all of the forms and documentation must be submitted by the deadline. That includes the CPA attestation. And there is the link to our portal system. So let's talk a little bit about that portal. If you all will bear with me, I am going to switch over one of my screens really quick. I'm having a little bit of difficulty, and this will just take one moment. And then I think we should be good. Okay, I cannot see you all now, but I can see my screen better. Could someone please give me an audio yes that you can see my screen well?
We're still seeing you, Kate. We don't see your screen yet.
Okay, I'm glad I asked.
We can see it now.
Okay, can you see the full screen now?
Yep.
Okay, great. So this is what our Enterprise Zone Application Submission System portal looks like. As you can see in the red box here to the left, if you click on these links, you can submit your applications there. Also over to the right, there are blue columns, and those blue columns have drop-down menus. When you select one of these, the menu will fall down and you'll get to see all of these different options underneath that. Each of these has the documents necessary or the supplemental forms that you may need to submit your grant. It's important to know that you should wait to submit your grant until you have everything that you need for submission. If you open this page and start to enter information and walk away, it will time out and you'll have to start over. It's best to do it all at once. And when you do submit, you will receive a few notifications to let you know that you did. Whichever email that you put in as your contact email, that email address will receive a notification that says you have successfully submitted your grant. In addition, you will receive, yes?
It's Angie. We can't see your screen anymore. We just see you.
Okay.
Sorry to interrupt.
No, thank you, Angie. I appreciate it. All right, let's try this one more time. I'm sorry about that, everybody.
Kate, we also weren't seeing the screen that I think you intended. We were still just seeing the Enterprise Zone map.
Okay, perfect. All right, how about now?
Yes.
Okay, great. So this is our Enterprise Zone submission portal. I'll start over there so that you can kind of get a visual idea of this now. Over here to the left is where you can submit your applications. And over here to the right is all of that information and the documents that you need to submit your applications. And then once again, I'll remind you to please submit everything at once. In order for it to be considered on time, you have to have all of the documents submitted. So let's go ahead and talk about eligibility. For the real property investment grant, a building or a facility that's located in an enterprise zone may be eligible to apply for a real property investment grant. The first step for determining whether a building or a facility is in an that local zone administrator will let you know whether the property is within the boundaries of an enterprise zone. So let's talk a little bit about the difference between a building and a facility. A building is a freestanding structure and it's unrelated to the other buildings or structures that are next to it. Those building and structures might have common ownership, but they may be leased to tenants and the owner has no say in the general management. So maybe they are all in the same general area, but they're not related in function at all. A facility, on the other hand, is a group of buildings that are co-located at a single location, and they're involved in related operations under common ownership and management. A good example of this would be a manufacturing facility. One building is where the actual manufacturing is done. Another building on the property are the administrative offices, and maybe you have another building on the property that is storage. that is considered a facility for our purposes, and everything that is considered part of that facility would qualify as one grant. And we'll go into that in more detail. The RPIG is available to investors that are undertaking rehabilitation, expansion, or new construction projects within those enterprise zone boundaries. In order to be eligible, the building or facility must be commercial, and that can include office and retail, industrial, or mixed use. For the purposes of our program, mixed use must be at least 30% of the usable floor space having been devoted to commercial, office, or industrial use. And we're going to talk a little bit about the specific documentation you must have in the case of a mixed-use building. So one question that I get often is who applies for the grant? So when we're talking about that, we call that person the qualified zone investor. And that's any entity or individual who is capitalizing on or expensing the costs associated with that investment. So they spent the funds and they put those funds on their books. So that can be a property owner, that can be a non-occupant or an occupant property owner. It may be multiple owners. And in that case, rights to the qualification should be coordinated between all the owners with supplemental documentation that we're going to go over. It may also be a tenant. Tenants making leasehold improvements may apply for the grant, but they must have the owner's permission, and they may only apply if the improvements are capitalized or expensed by the tenant. And then it could also be the developer. Rights to that qualification should be reflected in the sale documents if the property has been sold. And you don't have to maintain ownership to apply if you're a developer, but the right is always first to the current owner. And we're going to go over the supplemental documents that are necessary in that case as well. Zone investors must meet minimum investment thresholds based on construction type. So you can see here the chart in the top right-hand corner. For a new construction, the investment threshold is $500,000 in qualified real property investments. That's what that QRPI stands for. For a rehab or expansion project, the minimum investment threshold is $100,000. And we're going to go into detail about how solar affects property investment amounts and the threshold amounts. Those threshold amounts must be met each year that the grant is applied for, and they do not carry over to another year. And we have a grant cap based on that total amount that is invested in the property. So if the amount is less than $5 million in investment, then the maximum grant is $100,000. If the amount is more than $5 million in investment, then the maximum grant is $200,000. We base the grant amount on 20% of that qualified investment amount over the respective eligibility threshold. So let's talk a little bit about what that looks like, and we'll look at a chart. It'll help make sense a little bit more. So let's take a new construction project, for example. Let's say that the investment was $1 million. They meet the threshold amount, and we subtract that from the $1 million. So the total grant eligible funds left over would be $500,000. With a grant rate of 20%, you would have a grant requested amount of $100,000. If we are not prorated this year, then that grantee would receive the $100,000 amount. If we do have proration this year, let's say an example would be 88 cents on the dollar or proration of 88%, then that grantee would have a grant award amount of $88,000. In the case of a rehab or expansion project, let's use the example of a $500,000 investment. The threshold amount is $100,000. You're going to subtract that from your original $500,000 investment for a $400,000 total grant eligible fund amount. At a grant rate of 20%, the grant requested amount would be $80,000. And if there is no proration, then the grantee would receive the full $80,000. If there is, for an example, an 88 cents to the dollar proration, that grantee would receive $70,400. And we'll go over solar in just a moment. So what are qualified investments? Those qualified investments are hard construction costs. Those are any exterior, interior, structural, mechanical, or electrical improvements necessary to construct, expand, or rehabilitate a building for commercial, industrial, or mixed use. I like to say if you pick up a building and you turn it upside down and you shake it and you turn it back over, if it doesn't fall out, if something doesn't fall out of the building, it stays structurally intact to the building, then it's probably a hard construction cost, it's probably a qualified investment. If it falls out, if it's a piece of furniture, if it is machinery, if it is a refrigerator, a stove that's not structurally part of the building, it's going to fall out. It's probably not considered a hard construction cost. Examples of qualified investments include carpentry, ceilings, demo, doors, windows, drywall, HVAC, and the list continues. On page 12 of the RPIG manual, you can see an extensive list of qualified investments as well as non-qualified investments. Let's talk a little bit about those ineligible costs. Those are your soft costs. Those are your costs that go towards acquisition, permits, fees, things that are not tangible. So think of it that way. Also, furnishings, machinery and tools, signage, and any items beyond the property line. So no machinery and tools and no business personal property may be considered a qualified investment. Calculating the awards. So the dollar amount of the grant is based on the total amount spent in qualified investments. Grant awards are 20% of that qualified investment made in excess of the respective threshold. So of course, for your rehab and expansion projects, that threshold is $100,000. And for your new construction projects, that threshold is $500,000. Grant awards are capped based on the amount of investment and capped per building or facility over a 5-year term. So a grantee may receive up to $100,000 per building or facility for a qualified investment of less than $5 million and up to $200,000 for those investments that are over the $5 million mark. Here's another example of what that calculation looks like. If you have a rehab investment of $500,000, you meet that threshold amount, and we subtract that $100,000 for $400,000 in grant eligible dollars. At 20%, that's an $80,000 grant. Let's look at the situation to the far right that has the asterisk that is the rehab amount capped. You have a $2 million investment. This is a rehab project, so we're going to subtract the $100,000 threshold. That gives you $1.9 million in grant eligible funds. 20% of 1.9 million is 380,000. That is over the maximum amount that can be received, which is 100,000 in this case. If it were a $5 million investment or more, then that amount would be 200,000. So that is capped at $100,000 in this case. Solar eligibility. So in 2019, the Virginia General Assembly established legislation to allow investors to include solar projects as part of a qualified investment. And not only that, but those solar projects can qualify at lower thresholds. In order to be eligible to qualify, you must spend at least $50,000 in solar, specifically on the solar part of the project. Solar only improvements from $50,000 to $100,000 qualify with a threshold of 0. So you do not have a minimum threshold to make if you spend between $50,000 and $100,000. Solar, as part of a larger project, lowers the overall threshold by $50,000. So normally a new construction project would have a threshold amount of $500,000. There's a solar component to that project. You would subtract $50,000 for a $450,000 threshold. In comparison, a rehab or expansion project normally has a $100,000 threshold. If solar is a component of that project, you can lower the threshold by $50,000, which means that you would only have to meet a $50,000 threshold if you have that solar component. And here's another example of that. If you have a solar only project that's $75,000, you do not have a threshold amount because you're between that $50,000 and $75,000 amount. So your grant eligible amount would be $75,000. 20% of that is $15,000. That's your grant amount. Let's look at this chart a little bit. It gives you a good idea of where the thresholds are and what amounts to meet at the grant level to maximize the grant amount. So for a rehab or expansion, the minimum investment threshold amount is $100,000. For a new construction, it's $500,000. The sweet spot for that rehab or expansion is spending $600,000 in qualified investments because the amount of investment required to maximize the grant at $100,000. So think of it this way. You have $600,000 in investments. We subtract that $100,000. You have $500,000 in grant eligible money. 20% of that is your maximum grant amount of $100,000. And the same thing goes for the new construction. That sweet spot is $1 million. The upper threshold amount in both cases is the $5 million. That's what activates that second $100,000 for the grantee. To be eligible for grant year 2022, a property must have been placed in service in calendar year 2022. That's any time between January 1st and December 31st of 2022. And a copy of the placed in service documentation must be submitted with all applications. There are 3 types of placed in service documents that we accept. The first 2 types are specifically for projects that required permits from the locality. That's your final certificate of occupancy or your final building inspection. If there were no permits for that work required by the locality, then you may submit a final third-party inspection. That final third-party inspection has to be carried out by a Class A contractor. And I am going to be answering questions during the question and answer session after this. Required materials. Every Virginia Enterprise Zone grant, whether it's a real property investment grant or a job creation grant, must submit a Commonwealth of Virginia W-9. It's really important to make sure that the grantee, whether you're the grantee or we have a lot of local zone administrators on the call, that you are using the Commonwealth of Virginia W-9 and not a federal document. In order for us to process your check for this grant, we have to have that document, and that document's on our website and our portal. You must submit Form Easy RPIG, and this year, this is a specific announcement for local zone administrators. This year, as in years past, that form has your applicant declaration and your LZA verification on it. There's also a separate LZA verification form that can be used. As long as you either turn in the Form Easy RPIG with the signature of the LZA or the separate form, either one will be accepted and will be classified as eligible. Please submit supplemental forms. We're going to go over those supplemental forms, the cases in which they are needed and what those forms look like. You have to submit a placed in service document, and then of course your CPA attestation report. And those are submitted with all RPIG applications. So if you are a business owner and you are applying for this grant, the first step that you want to do is reach out to your local zone administrator to make sure that you're eligible, you're in the enterprise zone boundaries, and you're meeting some of these other qualifications. The next step is to reach out to your CPA. The CPA has to be a third-party independent CPA from your company. It cannot be someone who is a CPA who works for your company. If you have a CPA that your company does business with annually, they do stuff for you on the side, they do your books, whatever. As long as they're independent of your company and not an employee of your company, you may utilize them. We have a list of CPAs on our website that have done this work in the past and are very thorough, and they know what they're doing in terms of the CPA attestation. And really the job that the CPA is doing is they're making sure that you're hitting all of these eligibility requirements, and they're going to help you through this process. And I'm here to help you with that as well. Here's what that Commonwealth of Virginia Form W-9 looks like. The FEI-9 is required. We must have that in order to process your grant. This year, the unique entity identifier, the UEI number, has been added to the form. It's circled right here. That is not a requirement of DHCD. It is just part of the statewide form that we use. Once again, that is not a requirement. The remittance address must be the address to which the company wants to receive the grant check. Right here, the second circle is the remittance address. Very often, that's a different address than the physical address of the building for which the grant is being applied. So if you usually receive your mail through a post office box and not to the place where this building is, then you need to make sure that that's in the remittance address so that you can receive your grant. This is another reminder for CPAs and for anyone filling out this form that disregarded entity should never be checked as the taxpayer identification here on this screen. If the company is applying as a disregarded entity, then the W-9 should be submitted for the company or the individual that's capitalizing on the investment and not the disregarded entity itself. That's something we get questions on a lot. And if you have further questions about that, please feel free to reach out to me or to ask them at the end. Let's go over Form Easy RPIG and the online form and talk about how that is filled out and the information that's necessary. So in case you don't know, in the past, everything was a hard copy submission, and that was Form Easy RPIG. It hasn't changed. So now we require Form Easy RPIG to be uploaded. You print it out or you fill it out on the form on the screen, and then you upload it into our application portal. And part of the application portal is the exact same information that's asked on Form Easy RPIG. Yes, it is redundant and we know that, but that helps us to get that information into the system so that we have it for our purposes and for your purposes as well. So this is part one. This is all background information about the entity that's applying. You're going to put the qualified zone investor's legal name and FEIN. Number two, you do not have to put an EID suffix here as part of that FEIN. You're going to check what type of zone investor you are, and then you're going to put the physical address of the zone establishment. So the physical address of the building or facility for which you are applying. You're going to mark which property use classification. If it's a mixed use, you're going to have supplemental forms. You're going to mark whether it's a building or a facility. If you have any questions at all and are unsure if your property is considered a building or a facility, please reach out to your local zone administrator or reach out to me and I will help you to determine that. You're going to check what type of real property investment was made. This helps us to establish the threshold amount that must be made in order to qualify. Number 8 is the property identification number. This is something I get a question on a lot. This is your parcel ID number, your tax parcel number, your tax property identification number. There are lots of different names for it in different localities, but this is the identification number that your locality uses for tax purposes to identify that property. Numbers 9 through 13 are filled out by your local zone administrator. That's the zone name and number, the designation date, their name, their signature, and the date. What the LZA is signing off on is that they have checked to be sure that this property is located within the boundaries of the enterprise zone. And that's the only thing that is required of the LZA this year is to sign off on that. And once again, the LZA may sign off on that on the Form Easy RPIG as seen here or on the separate LZA form. You do not have to do both. Number 14 is something that we've added in the last 2 years. It is a narrative summary of the project. This is where you can explain what the project was. If you were giving a brief elevator spiel to someone and you were just telling them about the project, what you're accomplishing, what work was done, any plans for work in the future, any helpful background information on the project, that's what you're going to put here. As you know, we are reviewing hundreds of these grants each grant year within a short period of time. It's 1.5 to 2 months. And so just getting that narrative helps us to jog our memory if we've talked to you in the past and say, oh yeah, I remember talking to them about this project. Or if we haven't, it helps us to get a better idea of what the project was. Part 2 is the placed in service documentation. In Part A, you're going to mark which type of placed in service documentation. And in B, you're going to tell us if there was any difference in the name and the address that's listed on this form compared to the placed in service documentation. And if there is, you have to tell us why. And this is also part of the CPA attestation process. They fill out this part as well to explain that information. Part 3 is the itemized list of qualified investment. You are going to individually list each qualified investment and the dollar amount, and then the total qualified investment at the bottom. So this is one thing that the CPA will help you to do. When you work with your CPA for your attestation, you give them all of your invoices and receipts and your AIA documents, and they're looking over those and comparing them to your books to make sure that Number one, they were all qualified investments, and if they're not, they'll take them out of the list and only put those that are qualified investments in on the list for this grant. They are also going to be making sure that they were all capitalized on your books or expensed on your books, and you're going to submit this on the form, but then there's also an Excel sheet that looks very similar to this, but the Excel sheet has a formula that quantifies that total amount for you, and you upload that into the system. And for anyone who's not been in the system, if you're a little nervous about it, if you're not ready to submit your grant, you can still go into the system and look at it and look at what it requires from you. Also, see, I saw a question in it and I lost my thought for a second. Also on the system, there are prompts for everything that you need to upload. So you're not expected to just know what you have to do in each section. There are instructions and prompts. Here's that example of that Excel sheet. That's the itemized list. Part 4, your qualification information. So the first part is where you're going to put the date of the final placed in service document. So that date has to be somewhere in calendar year 2022 to be eligible this year. Number 2 is the qualification year. That, of course, is 2022. And then number 3 is how we figure out the grant grant calculation information. 3A is the dollar amount of your total investments made, those qualified investments, those hard construction costs. Part B is the threshold. So for a new construction, that's a $500,000 threshold. For a rehab or expansion, that's $100,000. Part C and B are important because you must indicate the amounts, 3C and 4B are important because you must indicate the amount of any public funds and previous RPIG awards within a 5-year cycle. So those public funds can be any federal, state, or local grant money. So if you received a grant from your Main Street organization to do a facade improvement, that money that was used to do that facade improvement and that facade work cannot be included in your qualified investment amount. You cannot use any other public funds. And then you also must list if there was a previous year in the last 5 years in which you received grant money. Online on the application in the submission system, this will all formulate for you once you put in some of these numbers. The next part is where you're going to upload your documents. As you can see, you upload your placed in service document, the CPA attestation form, that Excel sheet, that's your itemized list, your Commonwealth of Virginia Form W-9, your Form Easy RPIG, and then your supplemental forms, which we're going to go over. We will not accept password protected documents this year. We also will not accept a document that has everything uploaded into one PDF. So you can't take your placed in service document, your CPA attestation, and your itemized list and upload it into one document and submit it one
You
time.
have to do, yeah.
Each one must be uploaded individually. Let's talk about those supplemental forms. Supplemental forms are required if investments were made to a mixed-use building.
Is it just me, or have you heard anything
Is it
else about,
or if the zone investor owns a space within a building or a facility. So for a mixed-use building, the purpose of that mixed-use supplemental form is to verify that at least 30% of the usable square footage in the building is devoted to commercial, office, or industrial use. If there are common areas that are accessible to the commercial space, this may be counted toward the commercial use. And an example of that would be a lounge or a conference room. Form Easy RPIG mixed use must be completed by the preparer of the measured drawings or plans for work done to the reference building. And the preparer of plans must be a licensed third-party architect, surveyor, or draftsperson. So the CPA, when they're doing their attestation process, they're going to review the status of the license of that preparer. And they're also going to review the supplemental form to make sure that it's correct, it's signed, and it's dated appropriately. So for grant coordination purposes, supplemental forms are to ensure that grant caps are not exceeded. If owners and tenants do not coordinate their grant applications, then DHCD will determine the grant amount available based on the cumulative amount of real property investment made to the property or a proportion of square footage leased or owned by the zone investor. So here's a chart. It shows you the situations in which you have an applicant and the investment. So if a tenant is making leasehold improvements and they paid for those leasehold improvements, they're on their tax books, then they're going to apply for the grant. If the improvements were made by the landlord or owner under a capital lease, then the tenant applies for the grant. If the improvements were paid for by the landlord or owner as part of an operating lease, then the landlord and or the owner will apply for the grant. Common errors that we see on grant applications is that the placed in service documentation is not final, or it indicates pending work or failed inspection. So if you had someone come out to do a final inspection and they noticed that one of your railings wasn't structurally attached correctly, and it says, you know, final inspection pending fixing front step railing, then that does not count as your final inspection document. We need to see that that work was completed and that there is nothing pending. So the zone investor must apply for the grant year associated with the calendar year of their final documentation. And the placed in service document for consecutive phases of a project were received in a different calendar year. So because our eligibility is based on the calendar year that each certificate of occupancy was received, then each certificate of occupancy would require separate application. So let's say you have a very large project and phase one is going to be completed it was completed in 2022, and you're applying for phase one in 2022, and then they're doing a separate phase this year, and you are thinking that you want to apply for the grant in 2023 so you can apply for both phases at one time. That is not something that you can do. You have to apply for each phase separately because it's based on when you receive that final place in service documentation. And if multiple phases of work are completed on a single building or facility within that same calendar year, then you must only meet the minimum threshold one time. Common errors. The application spans multiple addresses in the case of a facility, but only references one address in the certificate of occupancy. So zone investors can apply for work covered under the place in service document. If the work covers multiple addresses, then you should then multiple COs should be presented, or the CO should reflect all addresses. And this should be noted both in the CPA attestation and on your Form EZ RPIG. It's important to know that if you applied for a grant in the past, please make sure that you enter the information the same way that you did in the past, especially when it comes to the address. That's often how we pull up previous grants. For instance, if North is part of your address, and last year you entered it as North spelled out, this year don't enter it as in period or just in. Make sure it's the same, or in our system it won't pick up on it as the same property, and there could be mistakes that are made because of that. Another common error are vague or conditional items listed on the schedule of investments. So it's very important to break down those items. So site work, that needs to be broken down into the different pieces of the site work. And then a lack of detail when including conditional items. So instead of simply listing change orders, you need to tell us what was included in those change orders. And that's something that usually the CPA will let you know as well. So I'm going to take a sip of drink and I'm going to pull up this chat because I know that there were questions coming in as I was talking. Okay. First, I see Angie says, I've been told retail did not qualify for jobs grant. Is that true? Most of them do not pay the required amount or offer benefits. Yes, that's true, Angie. Retail is eligible for the real property investment grant, but not the job creation grant. Taylor Newton said, if machinery is secured to the property by water, sewer, and electrical wiring, is this considered I would have to talk to you about specific examples, but I'm going to say that most likely the answer to that is no. It has to be something that is structurally needed to complete the building. Will we be able to obtain the slides from this presentation? I will try to see what I can do about that. That is harder. You will have access to the webinar video from our website. And then also all of this information is from the manuals that you can pull up online on our website and on the portal. Mary Zirkle, can local governments as owner take advantage of the solar benefit if the project is for a solar field only, AKA no buildings? So local governments cannot apply for the real property investment grant at all. So they would not be eligible. Joanna says, Kate, to do this attest work, the CPA must be subject to peer review by the VSCPA and AICPA. Yes, thank you, Joanna. Is there a threshold for the solar component of rehab with solar? Is there a minimum spent on solar to qualify? Yes. Let me go back to that solar slide. That might help. So to qualify, you have to spend at least $50,000 in solar. Solar only improvements. So that's if you have a project where they're not doing any other work, they're only adding solar panels to a building, then they have to spend between $50,000 to $100,000 to have a $0 threshold. And solar as part of a larger project lowers the overall threshold by $50,000. If you have more questions about that, please feel free to reach out to me and I'll be happy to talk to you about it. Brian Donahue says, would a multifamily property with ground floor space devoted to a rental office, conference and meeting space, gym, etc., equal to 30% of the building area qualify as mixed use? Okay, let's see. A multifamily property with a ground, it does not sound like they would, because the rental office, the conference and meeting space, and gym are all for the use of the people who live in the building. So it's not a commercial, that wouldn't be counted towards commercial. We can talk more in detail about that project if you would like, Brian. I'll be happy to talk to you. All right, Mandy Archer says, do you still have a list of potential CPAs that do this work? Yes, ma'am, we sure do, and I'll be happy to send that to you. I think it's on our website, but I'm going to actually make a note right now to be positive that it's up there. And I actually just updated that list this year and included all the CPAs who completed attestations in the past 2 years included on that list. Kim Tucker says, what if a business that would have qualified for RPIG in Grant 2022 sells the business during that same year or in January of 2023? Does the buyer of said business qualify for anything? So it depends on who capitalized on the investment. So let's say that company A is the one who completed the investment. It's on their books. They capitalized on the investment and then they sell it to company B. Does company B qualify for anything? If they did, they would have to have explicit permission from company A. This is a special situation that I would have to probably get more information about. I don't know if Tori's on the call, and if he is, if he wants to add anything, but I would love to talk to you about that more, Kim, and get a little bit more information and talk about that. Yeah. Are there any other questions that someone would like to put in the chat or say out loud? And Tori, feel free to jump in if you would like.
Yeah, I think we would probably need some additional information on that one. So Kim, if you could send that to us, we could take a look at that specific. It doesn't sound like it's a developer buyer situation. So yeah, we need some more information just to make sure.
Thanks, Tori. All right, Mandy, I see you with your hand raised. Go ahead.
Yeah, I had one other. I think I know the answer. I just want to double check. State,
Sure.
like state governments, or like probation offices that may have done renovations to a building, they're not eligible either. Is that correct?
That's right.
Okay. So, but if the building owner made the renovations themselves and then the state entity is the tenant, the building owner would be eligible.
Yes.
Okay. Thank you.
Thank you. And also vice versa. If let's say that your local EDA is the owner of the building and they have a tenant in one of their buildings and the tenant is the one who capitalized on the investment, then the tenant could apply for the grant. Any other questions on the real property investment grant? If not, we will move forward with the job creation grant. So this is just a reminder page that we no longer accept those hard copies, and the deadline is 11:59 p.m. on April 3rd of this year. All forms must be sent in order for the application to be considered on time. And I will be sure to put that link to the portal in the chat, or maybe Annie or Tori could do that for me now so I don't forget, just so that you have it and you can easily have access to it. So let's briefly go over the summary qualifications for the job creation grant, and we're going to go over each of these in detail. First, you have to be sure that it is, of course, within the boundaries of an enterprise zone. The positions for which you are applying are permanent and full-time. They are net new positions for the state of Virginia. They're over the 4-job threshold. They offer at least 50% of health benefits, and they meet minimum wage requirements. Let's talk about what each of those eligibility qualifications means in detail. So we know that within those enterprise zone boundaries, we know that to find that out, the best place is to contact your local zone administrator. They are usually in your economic development office within your locality. If you go on your locality's website, you can usually find it there, or you can reach out to me and I'm happy to tell you who your LZA is. So permanent full-time positions, that means that they are jobs of an indefinite duration. They may not be temporary or seasonal, and they must require the employee to report to work within the zone on a regular basis, and that's at least once a month. That's really important for the current times in which we have a lot of people who are working from home. They must report to work at least once a month. And the position must be normally scheduled to work either a minimum of 35 hours per week for at least 48 weeks, a minimum of 35 hours per week for a portion of taxable year in which the employee was hired, or a minimum of 1,820 hours per year if standard fringe benefits are paid by the business firm. We'll go over that in more detail too, if it's a salaried employee, how you calculate that. What does net new mean? That means that those jobs were not churned. They were not moved from one location in Virginia to another location in Virginia. They are brand new jobs. They've never had that specific position in the company before. One thing that I think is most important to remember when you're thinking about the job creation grant is that we're talking about positions. We're not talking about people. So if you have a person who is in a new position, this new position is created. You have one person who's in that position for 6 months. Say they move on to a different job at a different place. If you fill that position later in the year with another person, then you can receive grant money for those 6 months that that first person worked and for the remaining months in the year that the other person worked in that position. It's based on position and not person. Qualifying job creation grants are for new or existing businesses. So it can be a brand new business or an existing business who have created grant eligible jobs over base year employment levels. So when we say your base year, that means either of the 2 calendar years immediately preceding the firm's first year of grant eligibility. So if this is your very first year applying for the grant and it's your first year of grant eligibility, then you can take either calendar year 2021 or 2020 as your grant year eligible for your base year. New businesses will have a base year employment of 0, and all businesses must meet a 4-job threshold. So just like we have that minimum threshold for the real property investment grant, we have a 4-job threshold for qualification for the job creation grant. So that 5th job is the first job that's eligible to receive a grant. Those first 4 jobs are just part of the threshold that have to be met. In order to qualify, that position must be offered at least 50% of the eligible employee's health insurance premium. The employee does not have to accept that in order to be eligible, but they must be offered, and they must meet minimum wage requirements. We're going to go in detail about what those minimum wage requirements look like and how that's changed from previous years. And finally, they must not be restricted positions. Positions that are not eligible for this grant include personal service, food and beverage, retail, units of government, and nonprofits, except business and professional organizations. As you can see, we have the NAICS codes listed here. In our job creation grant manual, there is an appendix that lists all of the eligible NAICS codes and all of the ineligible NAICS codes for you to utilize and to double check whether that is qualified or not. Minimum wage requirements. So job creation grant awards are determined based on wage rates and the number of full months worked in the grant year. So often other incentives are calculated based on how many years that position was worked or how many years that person was in position. We do it based on full months rather than years. So a company may receive up to $500 per year per net new permanent full-time position earning at least 150% of the minimum wage, and that can be 125% in high unemployment areas or SWAM certified businesses with offered health benefits. We're going to go into detail about that some more in the next slide. A company may receive a higher grant amount of $800 per year if that position is earning at least 175% of the minimum wage with health benefits and meeting all the other eligibility requirements. A company can receive receive grants for up to 350 positions per year. In last year's General Assembly, they made some changes to minimum wage requirements, including the definition of minimum wage for our grant purposes. In the past, we utilized the federal minimum wage to determine what the minimum wage was going to be for this grant. Now, minimum wage is defined as the federal minimum wage or the Virginia minimum wage, whichever's higher, as determined for the current calendar year as of December 1st of the prior calendar year by the department. And that determination is continuously in effect throughout the calendar year, regardless of changes to either the federal or state minimum wage. So we are in calendar year 2022 for grant year 2022. When we were determining the minimum wage requirements for that, we were looking at December 1st, 2021 data from the Virginia Employment Commission and looking at that state annualized data to determine what minimum wages would be. So at that time, the Virginia minimum wage was $9.50 per hour. The federal minimum wage was lower. That's why we take the Virginia minimum wage. So all businesses qualify for an $800 grant per employee if that position meets 175% of the minimum wage, and that's $16.63 per hour. For the $500 grant, the position must be paid at least 150% of the minimum wage, $14.25 per hour. However, high unemployment areas, that's what HUA stands for, and your SWAM certified business, that's your small women and minority owned businesses, may qualify at a lower threshold of 125% of the minimum wage, which is $11.88 per hour, to receive the $500 grant. New minimum wage requirements will or may affect previous grantees, and positions that were eligible in the past may not be eligible if they do not meet these new wage rate thresholds. So if you are a company or you're working with a company that previously qualified for job creation grants and you are applying again for your second or third year, you must meet the current wage requirements for your positions to qualify for the grant funds. So as a reminder, we're accepting applications for grant year 2022 from businesses that have increased employment over their own base year employment by more than that 4-job eligibility threshold during calendar year 2022. And a CPA attestation is a requirement of the job creation grant, except when a company has a base year employment of less than or equal to 100 permanent full-time positions and grant eligible positions are less than or equal to 25. So that kind of takes the necessity of the CPA attestation off of some of those smaller businesses who have a smaller base year in employment and a smaller amount of grant eligible positions. So here's an example of how the award is calculated. Let's say that your base year is 2020 and your employment level at that time was 10 permanent full-time employees. That's what PFTE stands for. Then in 2022, by that time, you had 20 permanent full-time employees. That's your grant year employment level. All positions met all of these qualifications that are necessary to be eligible. So your calculation would be your grant year number, which is your 20 grant year employees, minus your 10 base year employees, minus your 4 job eligibility threshold. That gives you 6 grant eligible positions at a $500 grant amount. So 6 times your $500 is an award up to $3,000. And once again, these job creation grants are not prorated. We fund these at 100% first, and then the real property investment grants. So let's talk about high unemployment areas. High unemployment areas are determined by looking at 3 different factors in the different enterprise zone localities. Those factors include your unemployment rate, your free or reduced lunch rate in the public school systems, and then also your median household income. I take that information and put it all into an Excel sheet and we tally it all up. And if it is at a certain level, then you are considered a high unemployment area. The chart shows you the zones that are considered high unemployment areas for this current grant year. And businesses located in those areas are eligible to apply for the grant at that reduced wage threshold of $11.88 an hour, which is 125% of the minimum wage. Any existing business that has previously applied for the grant as an HUA applicant in one of these zones may continue to qualify at 125% of the minimum wage for the remainder of their 5-year grant period. Any new businesses applying in these zones must pay at least 125% of the minimum wage to apply. SWAM certified businesses. 2021 legislation passed allowed for SWAM certified businesses to also be eligible for the same lower wage rate threshold as the HUAs. That's 125% of the minimum wage, which is $11.88 an hour, and that qualifies for the $500 grant amount. To be eligible at the reduced wage rate threshold, the company must have been SWAM certified in calendar year 2022, because that's the year that they're applying for. SWAM certified businesses must use Form Easy JCG HUA SWAM and JCG HUA SWAM worksheet. That's something I want to reiterate. For the job creation grants, there is a Form Easy JCG and a Form Easy JCG HUA SWAM. If that's not enough acronyms for you, I don't know, because that's a lot. But you're going to have your standard application, and then you're going to have your lower wage rate threshold application for HUAs and SWAM certified businesses. The same goes for the worksheet, and we're going to talk about the worksheet in detail. The worksheet, there's a standard worksheet, and then there's a specific worksheet for HUA and SWAM certified businesses. There's an online directory that you can look up to ensure that a business is SWAM certified, and I think that Tori has put that in the chat as well. So let's talk about the grant term for the job creation grant. The grant term is 5 years, and in order to be eligible within those 5 years, for each year, you must maintain or increase employment over the base year employment by at least 5 net new permanent full-time positions. Because remember, those first 4 jobs are your minimum threshold you have to meet. That 5th job is what triggers the grant and is the first job that will be eligible for the grant. After the first 5-year grant period, possible qualification for subsequent grant periods may be allowed if the company is still creating new jobs that are eligible. So you can apply and you could receive grants for your first 5-year period, and then you can continue to receive grants for 3 more 5-year periods after that. So a company may receive grants for a total of 20 years as long as they're maintaining and increasing employment over that base year employment. And this shows what your, this shows what your base year amount is going to be based on when you're starting that subsequent period over again. And if you have questions about that, we can go over that. But this is for people or companies that have applied in the past and they're starting a new 5-year period. Let's go over the JCG worksheet. That has to be filled out from left to right. It's an Excel worksheet. There are formulas involved. If you don't fill it out left to right, it might mess up the formula and you might not get the correct information. Do not skip any of the columns for that reason. Do not change the formulas. Some cells are hidden on purpose. You don't need to unhide those. And cells will turn red to signal potential errors. We're going to talk about that in more detail. This is what the JCG worksheet looks like. It can be a little overwhelming for people, but I think that once we go over each column, it makes it a little bit more doable and more easy to understand. So let's do that. So the first column in the peach color is the employee number. That is just your numbers 1 through whatever, however many employees you have to be assigned, because you're going to be in the CPA attestation. The CPA is going to possibly be referring to them by their employee number. The second column is for the CPA. That's where they're going to put a Y or an N for yes or no if that employee was included in the sample. The third column is the employee's name. You can see that there are 4 different rows that are highlighted in red, and that's because Henry Lee III and John Tyler Sr. were both included twice in the employee names. So if that happens, the Excel sheet's going to pick up on it. It's going to highlight it in red. It's to get your attention and say, hey, make sure you meant to put these twice. There's some situations in which you want to do that, and there's some situations in which you don't want to do that. You may have an employee twice if their wage changed during the calendar year. If that employee's wage increased or decreased in the calendar year, you're going to list them twice, once for each different wage rate that they had throughout the year. You can see that the next column is the last 4 digits of the social. Again, it's in red because some of these are the same. Again, you would have them listed twice if their wage rate changed during the year. The next 3 columns, are for a base year. I was going to name them, but I see that some of them are hidden, so that might be confusing. The first is the first work date in the base year. The second is the last work date in the base year. And then the blue column has a formula, and it tallies the amount of months worked in the base year from the 2 previous columns. The next couple columns are for your current grant year. You're going to enter the first work date in the first column and then the last work date in the next column. And then that light blue column has a formula in it which tallies the amount of months worked in the grant year. You have to put a Y or an N for whether the employee was offered health benefits. If it's an N, as you can see in this one N down here, the yellow column next to it is blacked out. That's because that employee's position is not eligible for a grant because it does not have health benefits offered. The next column is where the hourly wage rate is going to be entered. You can see that some of these columns are blacked out, and that's because the wage rate was too low. It was not the correct amount. In hot pink, the next column is the permanent full-time positions in the grant year that were not eligible. So they were not new in the grant year or not meeting wage or health benefit information requirements. The next one is the new permanent full-time employees in the grant year earning at least $14.25 but less than $16.63. And so that's the 150% but less than the 175% of the minimum wage. And then you have a column for those that were earning at least 175% of the minimum wage at $16.63. This is going to look a little bit different for the HUA and the SWAM JCG worksheet because it'll have different formulas and of course different amounts listed here in these pink and tan and peach columns over to the right. The JCG worksheet does have a second page. The second page, these values in column B are automatically generated from the information that's put on the first page. And these are the values that you're going to list on your Form Easy JCG. And it tells you right here where they're going to be listed on that form. So the number of all equivalent permanent full-time positions filled by the firm during the base year, the number filled by the firm during the grant year, new eligible positions filled in the grant year earning at least $175. So that's that maximum grant amount of $800. And then those at the $500 grant rate. So all JCG applicants must complete a worksheet or the JCG HUA SWAM worksheet, whichever is applicable for that situation. The JCG worksheet calculates those grant eligible positions filled during the grant year, and it automatically calculates qualification information to be used on the application, which is what we just went over. If a position was not filled for the entire grant year, then proration, of course, is based on the months employed, and that's automatically calculated in those columns for you as well. Based on the dates of employment, the worksheet will automatically distribute full months worked at each eligible wage rate requirement once the wage data is entered. All employees filling the permanent full-time positions in the base and grant year must be included on the worksheet. Positions that should not be included are positions that are not permanent, not full-time, not meeting that report to work requirement, food, beverage, retail, personal service, any of those other ineligible positions, and churned positions. Wage info only needs to be listed for your permanent full-time positions hired after the base year through the end of 2022 calendar year that have been offered the health benefits. And an employee given a raise during the grant year must be entered on a separate line for each wage rate, which is what we talked about earlier. So if you have a salaried employee, the way that you're going to figure out their wage rate is dividing their annual salary by 1,820 hours. That can include shift premiums and commissions, but should not include bonuses or overtime. So an example would be an annual salary of $32,000, conversion rate of 1,820 hours. You divide that and you get $17.58 per hour for your wage rate. Please make sure you print off those worksheets. In fact, print off everything that you are submitting or save a copy of it so that you have that. It's important in case something happens to our system, which we do not expect, but just to have in case, but also because your company may be part of a group that is monitored. Each year we are to carry out monitoring, and that is more of a detailed look at the information that was submitted on the grant. Required materials for the job creation grant include Form Easy JCG or the HUA SWAM form. We're going to go over that in detail. Once again, that Commonwealth of Virginia W-9 form, the CPA attestation form, and the applicable worksheets. Let's look at Easy JCG and the Easy JCG HUA SWAM. That just looks a little bit different from the standard form. They're pretty much the same. First, we have the same page, a very similar page as the one for the RPIG grant. This is your background information. Number 7 is important. You're going to check whether you're on the standard form or the high unemployment SWAM certified business. So if you were trying to do a standard application and you pull up the HUA one, you'll see that it lets you know that you're not on the correct form. Also, it's important to get the signature of that local zone administrator, ensuring that you are within the boundaries of the enterprise zone. This also looks very similar to the RPIG grant, the RPIG application. Number 1 is the grant requested for the appropriate calendar year. We go ahead and fill that for you. That's 2022. That's a reminder. And then you're going to check your qualification year. Is it year 1, 2 through 5? The base year used by the business firm, it's important to remember that the base year is a static number and it's going to stay the same throughout the 5 years of qualification. So whatever base year you use for your first year, you're going to use that again for all of your subsequent years. Here you're going to enter your information about the positions during the base year and the grant year that increase. So you're going to be doing some subtraction there, and then the net new jobs over the threshold. Whoops, excuse me, I didn't mean to switch to the slide so fast. Number 5 is your grant eligible employees with qualifying wage rates and health benefits. This is where you're going to list the amount of employees earning at least the maximum amount, the 175% that are qualifying for the $800 grant. Then on Part F, you list those that are at the 150% of the minimum wage. And then G tells us the number of new grant year employees meeting all of the wage and health benefit requirements. 6 is your grant request information. That's the amount of money you're requesting. And a lot of this information is part of that second sheet on your worksheet, and you're going to pull that. It's pulling directly from the formulas for the numbers that you entered on that first page of the worksheet. The attestation requirement is waived if a firm has a base year employment of 100 or fewer positions and creates 25 or fewer grant eligible positions. Waiver eligibility must be determined each year, so firms must still complete the and DHCD staff will monitor each firm who was able to waive the attestation requirement annually using procedures outlined in the CPA attestation manual. So we went over a lot of job creation grant information quickly. What questions do you have? I see a few in the chat. So Mandy, that HUA and SWAM certified businesses qualify at the same amounts now.
But you don't have to be both. I mean,
No.
you can be SWAM. It's just the same qualification, correct?
Yes.
Okay. And then I have another just clarification because I want to make sure I tell people correctly.
Sure.
You had mentioned, and also the guide says certified in 2022. That really just means they have that certification during the calendar year 2022, not obtained. But so they got it back in 2001 or something, but as long as they continue to maintain it, that's a qualification.
Yes, that's exactly right, Mandy. And that's a good point. I'm glad that you brought that up, and I'll be sure to reiterate that when I'm talking to folks. That's a really good point. Thank you.
You're welcome. Thank you.
What other questions do you have? I am putting the enterprise. Yeah, go ahead, Kim.
When I came to the in-person meeting in Portsmouth, we had some coverage about if we offer local enterprise zone incentives, do our wage requirements need to reflect what the new, does our language in our promotional materials or in our zone ordinances have to match up with what the state requirements are? Like we offer local job creation incentives as well as investment incentives. Our investment incentives have job requirements, but it usually says federal.
Sure.
It doesn't say whichever is higher.
Sure. So yes, those requirements have to be edited at the local level to make sure that they're correct for the state level. And you and I can talk about that, Kim, because I've sent out some information about that you all can use. But the actual, and I'm not sure if you were asking this too, but the actual local incentives do not have to be the same as the state incentives. But yes, you have to make sure that you're letting people know that the state incentives have changed.
But our local does not have to reflect those same. Okay.
No.
Okay. That's all I really needed clarification, is if that was some sort of mandatory thing.
Okay, great.
All right. Thanks.
Of course. I have put 2 email addresses. One is directly to the eZone box and one is my direct email. Please feel free to reach out to me if you have other questions. The next presentation is how to complete the CPA attestation process. And so it is mainly for CPAs. If you're interested in staying and you're not a CPA, you are welcome to do so. If you are not staying, I really appreciate you being on the webinar and for taking the time to learn about the qualification process. I am here to be a part of your team, whether you're a local zone administrator or a business. Please feel free to reach out to me and I'll help any way I can to make sure that we get your grant application processed. So if you're leaving, thank you so much for being on the call, and you can go ahead and sign off. And if you're staying, we will take maybe a couple of seconds and then we'll jump into the CPA presentation. All right, so let's go ahead and jump into the CPA agreed upon procedures. Agreed upon procedures test and report on the assertion of a business or qualified zone investor as to their qualification to receive enterprise zone grants. These agreed upon procedures are reported in the CPA attestation report, and they are a requirement for all real property investment grants and most job creation grants. The CPA must be independent of the company and currently licensed in Virginia, and it must be submitted by April 3rd, 2023 deadline with the rest of the application requirements. Findings must be reported on the required CPA attestation report forms. The form and the use of the forms have the support of the Virginia Society of CPAs. Please do not retype the procedures or submit findings using any other document than what has been provided by DHCD. The attestation report forms for both grants are available for download on the Easy Online Submission System site under the CPA attestation report header. Findings. Reports submitted that do not state the findings for each procedure are considered incomplete. The AICPA professional standards set forth state that the practitioner should report all findings from the application of the agreed upon procedures, and that a practitioner should avoid vague or ambiguous language in report findings. Examples of those appropriate and inappropriate descriptions of the findings can be found within section 201.26. Let's talk a little bit about the findings and how to state those findings. So based on the professional standards set forth, providing one's initials or, quote, no findings by each procedure does not constitute an adequate description of findings. So in that case, the application will be deemed incomplete. So an example, if the situation is that the CPA shall inquire of the source of all grant monies used to fund the investment by obtaining management representation, the response, no grant monies were utilized for this project, or a more detailed response of, we received this amount in local grants, but it was not included in the investment amount, would be acceptable. Please do not simply put no findings. All applications and additional attachments, including the CPA attestation, are due by 11:59 p.m. on April 3rd. If submitting more than one application, each application and the associated materials must be submitted separately via electronic submission. You will receive 3 application confirmations, including a successful submission of the online application, a notification of any deficiencies, and then once we go back and forth about these deficiencies, you will receive a notification of the resolution of those deficiencies. Let's talk about the agreed upon procedures for the real property investment grant. The zone investor will provide the CPA with the Form Easy RPIG, and of course, that is a form that's going to be uploaded, but all of that information that's on that form is also input into our submission system. They will provide you with all of the invoices and receipts for qualified investments capitalized or expended by the zone investor, and then they will provide the final place in service documentation issued for those completed investments. For a mixed-use building, they will provide the supplemental mixed-use form and the measured drawings for the building that indicate the square footage and the usage of the building. For zone investors applying as owners of space within a building, the closing documents or a deed of trust must be included to indicate the building's square footage. And for zone investors that are applying as tenants, they must include a current lease agreement indicating the building's square footage as well. CPA attestation responsibilities. So the attestation should report all the following. You're going to report on the Form Easy RPIG, and all other required attachments are complete, signed, dated, and that includes the supplemental documents that may be necessary. You're going to attest that the zone investor only included qualified investments and that all costs listed were either capitalized or expensed by the zone investor. The list excludes investments that were funded from public grants from federal, state, or local sources because those are not eligible. And then you're going to attest that the real property for which the investments were made was placed in service during the applicable grant year. And in this case, that's grant year 2022. The attestation should also report, if applicable, that the mixed-use building has the square footage information that's necessary and that is accurately indicated on the supplemental form. If the zone investor owns space in a building or the zone investor is implying as a tenant, then the CPA attestation will report the square footage info accurately and also indicate that supplemental forms and the grant application are coordinated with all of the other owners or the tenants within the building. So let's go through each procedure. Procedure 1 is the attestation of the completed application. The CPA will read Form Easy RPIG and report that all of the required attachments have been prepared in the prescribed format and that the form contains the signed applicant declaration section. So 1, completed and signed Form Easy RPIG, a completed and signed Commonwealth of Virginia W-9. You want to make sure that it's the Commonwealth of Virginia W-9 and not the federal form. And you also want to double check that their remittance address is correct because that is the address to which their grant check is going to be sent. And then you're going to attest to the copy of the final placed in service document. It must have the same physical address as referenced on the application, and the approval or issuance date must be within the current grant year, which is grant year 2022. If applicable, you want to look for the completed, signed, and notarized supplemental form for the mixed-use building. In the terms of a multiple owner situation, you want to make sure that the multiple owner form is completed, signed, and notarized. In terms of a tenant owner situation, you want to make sure that the tenant owner consent form or the tenant coordination form are also completed, signed, and notarized. Procedure 2 is an attestation of those qualified investments. So the CPA will read the itemized list of the qualified investments as well as the invoices and receipts to determine that only qualified investments are listed. As a reminder, qualified investments include expenditures associated with any exterior, interior, structural, mechanical, or electrical improvements necessary to construct, expand, or rehabilitate a building for commercial, industrial, or mixed use. That includes excavations, grading and paving, installing driveways, and landscaping or land improvements. In the case of cost categories listed on the schedule that include more than one type of work, for instance, drywall and demolition, a breakdown of the work included in such category will be obtained by the CPA and read to ensure that all cost categories are qualified investments. The CPA will report any items whose qualifications are uncertain, including the exact dollar amount of the qualified investment submitted on electronic and hard copies, which are uploaded, not sent in, of Form Easy RPIG. The CPA will compare the schedule of qualified investments to general ledger entries to determine that the items and costs listed on the schedule were charges to the appropriate capital asset account or expense account. The CPA will obtain and read 100% of invoices, receipts, AIA reports, and any other relevant documentation of construction expenses, and will compare these documents to the dollar values presented on the qualified real property investment schedule and report on whether the charges agree. The CPA shall obtain and read the itemized list of investments and the contents of their attestation report to determine whether the total qualified investment reported on the form meets the applicable minimum investment thresholds. And of course, for your new construction, that's the $500,000 threshold. And for your rehab or expansion, that's the $100,000 minimum threshold amount. The CPA shall inquire of the source of all grant monies used to fund the qualified investments by obtaining management representation to determine that federal, state, or local source grant funds were not used to purchase items on the schedule of the qualified investments. Procedure 3, attestation of the placed in service documentation. The CPA will read the placed in service documentation, which indicates that work is complete and up to code as evidenced by the placed in service date. The placed in service date indicates the calendar year in which the zone investor applies for the grant, in this case, 2022. The CPA will read to ensure that the placed in service document is final, not pending. No other documentation was issued or is pending by confirming with the locality's building office. And in cases which the final placed in service document was only for a portion of the building or facility, the CPA will read the QRPI amount to determine that it only includes work completed on the portion that's covered by the placed in service document. So if that placed in service document is a final certificate of occupancy, you're going to compare the physical address on the CO to the address on the application. You're going to read the CO to determine that the date is correct and it's from calendar year 2022. You're going to read the CO to determine that it indicates that it's final and not temporary or pending. In the case of a shell CO, the CPA will read the app to determine that the zone investor is not a tenant of the building unless they have signed a capital lease agreement and have coordinated with the building owner. And the CPA will read the final CO to determine that the name listed matches the name on the application. If not, then they want to include that in Part 2, Section B of the report. When that final placed in service document is a final building inspection, in cases where the building was in continual service during the rehab or expansion, or no change happened in the use or final CO required, then the CPA will read the final building inspection to determine that the physical address matches that address on the application. The CPA will read the final building inspection to determine the date of issuance was within calendar year 2022. The CPA will determine that it's approved, final, not pending or temporary, and they will determine that the name listed matches the name of the zone investor. Similarly, if the final placed in service document is a third-party licensed inspector's report, we have a reminder that that is only accepted in cases where the locality did not require any building permits or other permits for any of the investments listed on the schedule. And in that case, the CPA will need to read an official letter from the building code official to determine that it references the physical address and states that those permits were not required for the work. So that's important. So you have your third-party inspector's report, but you also need an official letter from the local building official. The CPA will read the report to determine the physical address is the same as that on the application, that it was final, that it was issued in calendar year 2022, and that the name also matches that was on the application. Procedure 4 is specifically for mixed-use buildings. It is an attestation of the square footage of the mixed-use building to determine that that building is meeting that 30% amount for commercial or industrial use to be considered eligible. When the building is mixed use, the CPA will determine that if the applicant has indicated mixed use, then they have also filled out that supplemental mixed use form. You're going to check that Part 2 of the form has been completed by the preparer of the measured drawings or plans submitted by the locality, to the locality. You're going to check that it contains the professional seal or notarized signature of the preparer, if not an architect. If no formal drawings were required by the locality or the zone investor prepared their own measured drawings, the CPA will determine that a licensed third-party architect or contractor has signed and sealed the form, certifying that at least 30% of the usable floor space is commercial, industrial, or office use. And then the CPA will determine that Part 2, Box 4 is mathematically correct and at least 30%. Procedure 5, attestation for owners of the space in a building. So this is the supplemental form when there are multiple owners of a building. And a good example of that would be an office condo. The CPA will determine that the square footage info indicated in the closing documents or deed of trust is accurately indicated on the supplemental form. The CPA must determine that the zone investor has coordinated qualification with all of the other owners of the building. If not, then we will prorate and use specific procedures to do that. The CPA will determine that if the applicant has indicated owned space in a building, that a supplemental multiple owner form has been completed and signed, and the CPA should compare the form to any backup documentation provided by the applicant, including closing documents or a deed of trust, and report on these findings. The CPA will determine that Part 2, Box 3 of the form is mathematically correct, and will determine that info in Part 3 of the form agrees with the grant requested by the zone investor on the Form Easy RPIG, indicating that either the grant request is being prorated or has been coordinated with all of the other owners of the space in the building. In the case of coordination, the CPA will determine that all the building or facility square footage has been accounted for by the other owner's notarized signatures, such that the sum of the square feet listed in Part 3, Box C, and the square footage listed in Part 2, Box 1 equals Part 2, Box 2. So you're just making sure that you have all of the signatures of all of the owners. Procedure 6 is the attestation of tenant or tenants in a building. So when the applicant firm is a tenant in the building or facility, the CPA will determine that the square footage information indicated in the current lease agreement is accurately indicated on Form Easy RPIG tenant owner consent. The zone investor must provide the CPA with access to the lease. The purpose is to ensure that the zone investor has obtained the consent of the building owner. And if it's required by the building owner, that they have the coordinated qualification with all the other tenants in the building. Otherwise, we will use proration procedures. The CPA will determine that if the applicant has indicated tenant in building, then the supplemental form has been completed and the applicant has provided the valid lease, and that lease agrees with the information on the form. The CPA will determine that Part 4 and Part 5 of the form have been completed, whereby the owner of the building gives consent to the tenant to apply for the grant. You're going to determine that Part 3 is mathematically correct and determine that the supplemental form, all of the information on the form, agrees with the grant requested by the zone investor. So that is a very quick overview of the CPA agreed upon procedures. It's time to take your questions. I see Paul Fagan said, is the CPA required to confirm with the locality municipality directly that the CO or other placed in service documentation is final? We do have that as part of our procedures now, Paul. So it's not very often that someone would issue a final inspection, but then also require a CO. We had a situation, 2 situations last year in 2 separate localities in which a final inspection happened and then they required a CO after that. And so that is one of the reasons that we have this new requirement. Thank you, Paul. What other questions do we have? Well, if there are none, I'm going to thank you all for being here. We will have this webinar up on our website, and everything that you learned today is within the manuals on our website as well. I am going to once again drop the link in the chat for the Virginia Enterprise Zone webpage, as well as as well as a link for the portal, which I will do right now. And then I will also add my email addresses in on the chat as well. Please feel free to reach out to me. I'm happy to help any way that I can. And it's much better to ask questions before you get into the process and submit the grant rather than after submitting the grant. We can help you get it all figured out before submission and make sure that the application process is efficient and successful for you and for your company. So thank you again so much for taking the time to be here today to learn about the qualification process for the Virginia Enterprise Zone grants. I hope you all have a great week. Bye-bye.